Hello and welcome to our year in review. I'm Charlie Mattingly with Leading Edge Financial Planning, and we wanted to take a look now that the year is over on what we went through. What kind of year was it in 2016? And just like we do with our family sometimes, my family and I, we sit down at the end or beginning of the year and we say, what did we accomplish last year? With our kids, we say, what did you do well last year? Because we want them to know and we want them to be intentional about their successes so that they're repeatable. And last year was interesting because it was very volatile. And what we're going to show you today hopefully will help you go on in the future and go, hey, we've been through this before. We know this volatility is normal. And some of the things that seemed really, really important last year, we probably, frankly, won't remember in either a few months or a year from now. But we wanted to take just a few minutes of your time to review 2016, and we're going to review it in a unique way. We're going to look at headlines throughout the year. I think we can learn a lot from these headlines, and as you'll see as we go through, they're very fascinating and interesting, especially the timing of the headlines as well. But first, it kind of starts in the summer of 2015 when in August 24th, I think it was, we had another flash crash. And you can see right here, apologize for that. You can see basically the stock market takes about 1,000-point decline in one day. Now, it didn't finish the day 1,000 points down. It recovered some of that value, but it was scary nonetheless. We thought that after a couple days that was over, but it continued to be a rough fall and even a very difficult start to 2016. So we're going to show you some of those headlines and kind of review what it was like to go through that and then come out of the end of 2016 with a fairly successful return. But here's the highlight from August 24, 2015, or I should say the headline, and it was scary. There's no doubt about it. It made you want to do something. Your feeling is watching this happen is like we can't do something fast enough. And that's frankly one of our behavioral biases as human beings is our fight or flight reflex, and that's what kept us alive for thousands of years. But you want to do something, and sometimes in our business we say the opposite. Don't just do something, sit there. And that sounds counterintuitive, but when the markets are going crazy, sometimes on a day like on this one day in particular, the last thing you want to do is have a knee-jerk reaction. But it's difficult. It takes a lot of discipline. You can see in this headline. This is Royal Bank of Scotland, and their headline, frankly, or the recommendation is sell everything. And this is the day after. So, and frankly, if you would have done that, knowing now we have 2020 hindsight to tell us, you probably would have locked in those losses. Amazingly, about 3 days later, the headline is suddenly everything looks better. Now, the gist of this headline is basically when the government releases GDP numbers, there are several revisions. So oftentimes those revisions 2 or 3 times later look drastically different, and that's what we discovered on August 27th. So suddenly, had you sold during that flash crash, we may already be regretting that decision, and we may be wanting to get back in the markets at this time, hopefully. One of the things that we've been talking about for years now since 2008 is when are interest rates going to go up? When's the Fed going to raise the interest rates? And it's been in the headlines for years now, and everybody's making their predictions. And this headline has this individual Schiller. He's a Nobel Prize winner in economics, extremely intelligent person. And to his credit, if you went on to read this article, he would not predict anything, but they wanted to associate his picture with his headline so that it gave it some credibility, I guess. But we know that we just had an interest rate increase in December of 2016, and it was not followed by a market crash. And in fact, in most of history, when we've had Fed interest rate increases, there's not been market crashes. Now, sometimes the markets will go down, but believe it or not, if you look back at history and statistics, the majority of the time after a Fed raises interest rates, the markets go up. Of course, it depends on the time frame you're looking at, but a lot of embellishment there a little bit in the news. January, the declines continued in January, was very difficult. In fact, as you can see here, this hasn't started so badly in 84 years. That's a pretty serious headline and makes us, again, want to do something. hey, we need to change, we need to become more conservative now. But luckily, we have plans in place. We were very proactive, and we knew that we were in the right place with clients and investing, and so that's part of what makes this roller coaster ride a little bit more bearable. Because this is a difficult headline to see, and it definitely tests you, and it's definitely a good time to take some reflection and go, hey, am I in the right spot? Is my risk, is my investment allocation, is it correct for how I'm feeling right now? Because that's a big deal. The last thing you want to do is, when you're seeing these headlines, is to sell everything like the other headline recommended. There's things you can do, and we'll talk about that in a minute, but again, our reaction, our human behavioral bias reaction is to want to overreact to these headlines. And then we get into the prediction part. Now, we've talked about headlines a little bit, but now we're going to start seeing some predictions. And this is the author of the Rich Dad, Poor Dad book, which I've read is a great book. And his name is Robert Kiyosaki, for all of you that haven't heard of him. So he has some credibility. We don't think that credibility, or as far as I know, is in the investment world, but nevertheless decided to make a prediction and tagged a date on it, which is actually, for those that make predictions, is unusual for them to tag a date on it, because now we can kind of look back and hold them accountable. So obviously he was wrong, and thankfully we didn't follow his advice. The same way, this person is Jeffrey Gundlach, and you may have heard of his company, Double Line Capital. And we respect Jeff Gundlach. We read a lot of his material because he's very smart, one of the smartest in the business of investing. But again, some of these people, by the nature of their positions, are essentially forced to make some predictions about where they think the market's going to go. And the majority of the time, they're wrong. In fact, there's a lot of studies done that show versus listening, they compare the smartest people in the industry, their predictions, versus flipping a coin. And most of the time, you'd be better off flipping a coin if you want to know what's going to happen in the short term in the future. So again, we're glad we didn't follow this person's advice either, although we do respect what they do in our industry. Another one for you, Jim Rogers, used to be on Fox News occasionally. I don't think he's there anymore. 100% chance we'll have a recession within a year. Now, to his credit, if I'm not mistaken, this was in March of 2016, so he has a couple more months. So we'll have to revisit that to see what's going to happen there. It doesn't look like the chances are in his favor at this point. One of our favorites, I've been following John Hussman for a while. Again, another smart individual. I think he was a professor at a university, I believe it may have been Michigan, and went off to start his own mutual fund company. And he tends to be pretty pessimistic about the markets. This was in July 27, 2014. He said this stock bubble is beyond 1929 and 2007. That's pretty serious. 1929 was a Great Depression. So again, if we respect this person, we want to follow what they do. Luckily, John Hussman has a mutual fund we can go check out and see how would we do if we followed this advice and we respected what he said. Well, let's say we invest in the Hussman Strategic Growth Fund. And what made him, I'd say, respectable in the first place is that in 2008, he did pretty decent, considering the average equity fund was down approaching 40%. In 2008, he was only down 9%. Now, granted, this type of fund is not all stock, but I chose this Strategic Growth Fund because it gives him the ability to invest according to his beliefs. And again, if he believes we're in a bubble and he believes it's a terrible market, then he can invest as he sees fit in this growth fund. Now you can see one of the important things here is Morningstar. This is from Morningstar's research page. They've given him a rating of 1 star and negative. That's pretty bad. And you can see why here, because you may have done okay in 2008, but the rest of the years you would have really underperformed what you could have simply had in the S&P 500, or what we prefer would be a globally diverse portfolio. So 2016, he lost 11.5%. So again, sometimes we can devise strategies that may win in the worst case scenario, 2008. But the problem is you lose every other year, and so over the long term, you lose. So it's something that we got to watch out for in how we invest, because we can't prepare or you can't hope to win that one year and then lose every other year and be successful. That's just not going to happen. So that's essentially what it looks like happening with the Husband Strategic Growth Fund. All right. Now, finally, to wrap this up, what does it look like when we have those ups and downs, that volatility throughout the year? Well, in every single year, this is back to 1980, you can see the red dots that are at the bottom here. Means at some point during the year in 1990, the market was down 20%. At some point, you saw a 20% decline in your portfolio. Now, for the entire year in 1990, it was down 7%. Not a great year, obviously, but still, even in positive years, let's take this 31%. This is the yearly return, and it looks like about 96, 97 time frame. But during that year, at some point, you were down 11%, but you ended the year positive 31. So again, you got to be really careful what we see during the year through the markets because they're very volatile. 2016, the same thing. At one point during the year, probably March timeframe, you could have been down, depending on your portfolio, 11% and finished the year upwards of 8%, depending on your portfolio mix. So it just goes to show you what happens during the year does not tell the whole story. Okay, we want to focus on the bottom portion of this graph in that we believe that if we react to some of these news headlines or these predictions and we're in and out of the markets, what happens? You know, we've seen what it looks like in the form of headlines and then the graph previous, the statistics. But this is the real cost to that. Now, when prognosticators or predictors make their predictions and they're wrong, so be it. There's no penalty for them. There's nobody going to hold them accountable. The press might ask a question, follow up, but they've made 5 other predictions so that at least a couple of them may come true. And that's just the game of statistics that some of them play. However, if you and I follow the advice of some of these people that are very, very intelligent, very, very respected within the market, if we follow some of that short-term advice and we change our investments based on that or based on our emotions, this is what statistically we can expect to receive. The average investor, average equity investor, this is according to JP Morgan Asset Management, and this is actually from Dalbar Incorporated. They run these statistics every year and they calculate the average investor's return versus a standard portfolio. Now this is the S&P 500 and this is from, as you can see, 1996 to 2015. 60-40 portfolio. Inflation 2.3 during that time. And then the average investor, because of poor decision making, not intelligence, but just poor decision making, maybe a lack of discipline or lack of plan, better yet, 2.1%. Now that's pretty scary actually, because according to this statistic anyway, the average investor is not even keeping up with inflation. That's scary because when we do financial plans, we try to assume a conservative 6 to 7% maybe, depending on the scenario. But this statistic says a lot of investors are not even getting inflation. So that will, I can tell you offhand, that will destroy a financial plan. We don't want that to happen. So what do we do about this? Well, we take the time, as I mentioned previously, during these market downturns, during this volatility, we need to talk about it with each other. We need to reassess our risk tolerance and capacity for risk. Now I put those both in here because they're slightly different. Our risk tolerance, let's say, would be our ability, maybe emotionally, to withstand that market volatility. In other words, can you sleep at night? And that's going to change throughout your life. It's going to change with your circumstances. Now the capacity for risk is something a little different in that, you know, according to your financial plan, or according to your circumstances, how much risk can you take? How much risk should you take? Those are things we need to revisit constantly. And we need to revisit them during, before, and after so that we're proactive about it. Of course, we need to review our initial game plan or get one if you don't have one already. That comes in the form of a financial plan, looking at your retirement scenarios like we like to do. We look at worst case scenarios. What's going to happen if you retire? And the day you retire, the market goes down. Now, if you're not retired already and the market goes down tomorrow, that's not the worst case scenario. The worst case scenario is that 5 years down the road, 10 years, 15 years, whenever you retire, then that day the market goes down because you need to withdraw money and it locks in those losses. That's the worst case scenario. And we plan for that. We look at that. and we plan for that years in advance. Other things you can do during some of this volatility is you can rebalance your portfolio. In other words, if stocks go down, the value of those stocks, the prices of those companies more accurately, goes down. Let's say most likely then your bond portion will come up. That gives us a good opportunity to sell some of the bond portion because it came up in price and buy some of the equities, buy some more stock, mutual funds, or exchange traded funds. And in essence, that's a disciplined way of selling high and buying low. We take the emotion out of it. We use all discipline, sometimes perhaps a schedule, or if we're reinvesting on a monthly basis, we'll do it then. But that allows you to stay away from emotions, and it allows you with discipline to sell high and buy low, which is the opposite of what our behavioral biases would have us do. Also, we can take advantage of tax loss harvesting. And finally, don't let these short-term events affect your long-term plan. We appreciate your time today. Hey, send this on, forward it on to somebody you think might be interested, and we just love to help people. It's our passion in this business. If you or anybody that you know would like to schedule a few minutes with us, go to our website, leadingedgeplanning.com. Go to client resources, and then down at the bottom, you may have to scroll down a little bit. Check out our calendar. You can automatically reserve some time there. We'd love to talk to you and get your feedback, and maybe we can help each other get through these volatile times in the stock market, because there's going to be more. We've had a pretty good stock market since 2008. After that, the Great Recession, anyway. So we'll have a pullback at some point. We don't know when. We're not going to try to predict that, obviously, but just make sure you have a plan in place. Make sure you've thought about it, and again, reach out. Let us know if we can do anything. Thank you again, and hope you have a great 2017. Thank you.